Good evening, everyone, and thank you so much for attending this webinar. I have the great pleasure of introducing our speaker, Sujit Modi. Sujit is the founder and CEO of Quantic Capital, which has the OpenQ advisory brand, and you must have seen a lot of the WealthBaskets on the PL India WealthDesk site. Sujit is an alumnus of St. Xavier's College, Kolkata, with a CA and an MBA from ISB Hyderabad. He comes with over 15 years of experience in global equity markets with companies like Deutsche Bank and MSCI across different functions, such as research, systematic strategies, factor investing, risk models, and analytical tools. Today, Sujit is going to be talking about specifically the Pharma WealthBaskets and the defensive momentum WealthBaskets, both that I have personally invested in as well. And I keenly look forward to hearing from Sujit on how he goes about selecting the portfolio. And with that, Sujit, it's over to you. Please, let's start.
Well, thanks, Amir, and hi, everybody. So, as Samir mentioned that I represent a firm called Quantic Capital, who distributes his advisory portfolios as well as other products under the name of OpenQ. So before we move, I'll just quickly touch upon our firm as well as the kind of services we are involved into. So advisory portfolio is just one part of it, but we are essentially present in the entire stack of wealth solutions. So when you talk of wealth creation or wealth solutions, investment is one part of it, but you also need to know whether your investment is going in the right stocks or not. So then there is something called portfolio analyzer, where you, which acts like a course corrective tool, that if you are invested in a wrong portfolio, you use the analyzer and that puts you on the right path of wealth creation. Apart from that, we are going to come up with a web-based backtesting tool as well. If you have some ideas, you can quickly validate whether that idea actually makes money in the market or not. Then we have stock screeners, factor attribution models, as well as factor library, which is essentially the high quality data that powers all of our research, both in custom portfolios as well as off the shelf WealthBaskets. Our fundamental philosophy is that wealth creation should be a passive process, because it is very fundamental to human existence. Now, if something is so fundamental, then it should not be a very complicated process where everybody is doing trial and error, hit and miss, that everybody knows that only 5% of the traders in India makes money, but everybody thinks that they fall within that 5% bracket. And then that race keeps continuing, and only person who make money is everybody but the actual investor. So in OpenQ, what we believe is that we should come up with solutions where person can invest and forget and just follow the process, which with the help of WealthDesk, we keep sending notifications and so on. Stay invested, ride the cycle, and stick to the process is the mantra that we live by. And to make your investment journey very comfortable, we do all the heavy lifting at the OpenQ level, and with the help of WealthDesk and platforms like Lilladher, that gives us the last mile connectivity. With this, I'll just quickly touch upon factor investing. So what we do in factor investing is not something out of the world or something which we have created new. It has been there since 1960s and 70s. It became part of the mainstream investment world only in around 2008 after the global financial crisis. And today, particularly in Western markets, trillions of dollars are invested in passive strategies, which are built around factor as the central theme. So in India, we are trying to bring these factor-based strategies, largely because we feel that now the India market is ripe for such kind of strategies. And plus there had been a lot of regulatory changes, which makes the adoption of these strategies together with the availability of technology pretty seamless and easy at the end client's level. So now let's start with the typical investor's investment journey. When you want to invest in any stock or a portfolio, it is essentially trying to answer two questions. One is, what should I invest in? And second is, how much should I invest? Right? So it is essentially the stock selection and stock allocation problem. Now, what should I invest in is again a three-step process. First is whether a stock is a good stock or not. Second is whether a good stock is available to you at a good price or not. And third is whether the market is willing to take that stock from its good price to its right price. Now, what is right price? Different people will have a different opinion, but at least everybody agrees that the right price is different from its good price, And that is why there's a scope of return making over there. If we connect this logic with each individual factor, so like whether a stock is a good stock or not, that is captured by the quality factor, whether a stock is a quality stock or not. What does quality stock do? It essentially tells you whether the company has a strong balance sheet or not. Now, or a strong P&L or not. Now, different analysts will have a different way of evaluating balance sheet and P&L. Somebody will look at operating margin, somebody will look at leverage, somebody will look at return on equity, net working capital, and so on and so forth. We essentially look at return on equity as the first measure, return on equity or return on capital employed. Apart from that, there are other factors like stability of earnings, accrual, how much of earnings is in cash and how much is in accrual and so on. But the very base is return on equity. Now, why return on equity and why not operating profit margin? And there are technicalities. I'm not going into that right now, but I'll just touch upon saying that the stakeholders who run the company are equity shareholders. And if the equity shareholders get the decent return, they are the one who drives up the prices. So for the kind of task we are into, wealth creation through capital markets, return on equity is a much important metric, because essentially operating profit margin or sales growth, everything needs to boil down to net profit, which in turn gets converted into return on equity. Second is whether a quality stock is available to you at a good price or not. Good price basically means you are talking of value parameter, that you are connecting the returns or the strength of the balance sheet with the price at which market is discounting those numbers. ITC is a classic example. Strong balance sheet, good cash flow, market is not moving. Whatever may be the reason, different people have different theories around it. Third is good quality stock, good value, whether market is willing to take it to its right price. That is where the momentum comes in. So if all these three factors come together, your stock selection has a higher probability of making money. Now, this is another thing that a lot of time people tend to forecast that, this sector is looking good, this stock is looking good, we should invest. And then once you have invested, you expect market to fall in line with your view that, okay, I think this sector is good. Now let's wait for the market to actually start generating return on that sector or that stock. We don't follow that approach at all, because we believe we are not in the business of forecasting. We are in the business of high probability trades. We see where the market is moving. And if market is giving return to a particular sector or a particular stock, we say, let's go with that, because market is supreme and market will always be right. So that is essentially about what to invest in. How to invest in is essentially related to the weighing factor. How do you weigh the portfolio? And there are multiple ways of weighing it. Somebody weighs it by market cap, which is like all the Nifty 50 indices or Nifty 50, all the benchmark indices. There are equally weighted indices available. You can weigh it by its risk. That is, higher the risk, lower the weight. There's diversity weighting, and there are multiple ways of weighing it. In OpenQ, by and large, we weigh a lot of them, majority of them in the form of by its risk. That is, higher the risk, lower the weightage. Why do we do that? We will talk about it in subsequent slides. Now, let's get into the strategy part of it, which we want to discuss today, and which is the agenda of today's webinar, that is defensive momentum and pharma. But before we actually get into the strategy, I just want to briefly touch upon the design elements. How do we go about designing a strategy in the OpenQ? There are these are few of the checkboxes that that a strategy needs to tick before it can be put in production. So first is, strategy should have a self-corrective mechanism. Why is that important? Because we don't have a portfolio manager in-house. Everything is algo-driven, quant-driven. Now, quant-driven essentially means process-driven. Now, it might happen that process picks up a wrong stock for some reason. And, we're talking of markets, and no process can tame the market all the time. You can only design something and try to increase the probability of your returns. But the fact that we are talking of probability, it is imperative that you will go wrong many times. So when you go wrong, the strategy should self-correct itself. That mechanism should be built in your algo to start with. Second is, the CAGR should be 20% plus over the cycle. We have an internal threshold of 20% plus, because we believe that today, when we talk of ETFs, Nifty ETFs or Nifty index fund, we are essentially talking of 10-12% return over the cycle. But if you have a portfolio that gives you double the return that of the market, your wealth creation is happening very fast compared to the market. There should be implicit defense mechanism built in. Now, again, as I said, because it's an algo-driven process, at different point in time, different sectors and different mechanics works in the market. So right now, we have been seeing that metals and cyclicals are moving up. Tomorrow it might happen that, and it will happen at some point, that the metals will stop performing and some other sector will start moving. That defense mechanism should be there, that when a particular sector stops in which you are overweighted, the loss that you make by being overweight on a sector that has stopped moving, that loss should not be enough that you cannot neutralize that loss by moving on to the new sector. So that is controlled through weight allocation, and the which is essentially the risk weighing scheme I was talking about. Fourth is holding period. Why is holding period important? Holding period is important because when you are putting money in the market, you are giving up one alternative of investment and choosing market over that alternative. Now that alternative has some opportunity cost that you have given up. So if your holding period keeps increasing and your return does not is not more than the opportunity cost of your holding period, then the stock market investing is not really lucrative. So if your holding period is less, then the opportunity cost of investing in the market is also less, right? Fourth is, next point is implicit profit booking. A lot of time what happens is when a particular sector or a particular stock keeps moving up, people start allocating more to it. Nothing wrong with that strategy. It works fine. Market cap weighing is essentially that strategy, that as the stock is moving up, the weight of the stock moving up and the allocation keeps moving up. But the only problem is when the correction happens, when you fall from the top, you are falling with the highest possible allocation in that stock. So in the process, when you're falling, you're wiping off all the profit that you have made. So that is why we don't follow that approach. We follow a risk weighting approach, which has an implicit profit booking mechanism built into it. And that is one of the reasons why you will see in subsequent slides that whenever the market had crashed, even though we are following momentum-based strategy, our drawdown had been lesser than the market, because at every time a stock moves up, we keep booking a little bit of profit every time. And last but not the least, stop loss, which is the mother of all defense mechanisms, stock market, that no matter how good your algo is, no matter how rockstar a portfolio manager you are, at some point you will have to control your loss, and you can control losses either through defense mechanism and everything that I said at the time of portfolio construction. But at the same time, you need to control your loss at the execution level. So through WealthDesk, we have a stop loss mechanism wherein if any stock falls intraday 15% or more, or the portfolio declines from the top more than 20%, we hit the stop loss. Now, why 15% and 20%? Those numbers have been arrived at different multiple simulations and back tests. And we realize that any number less than 15% does not make sense, because a lot of times stock that has fallen significantly has a tendency of recovering more than 50% of that loss. Tata Chemical is a classic example in the recent past, where the numbers were not that great and the stock corrected, I think 15-20% over 2 to 3 days, and then a large part of that correction has been recovered now, right? So these are the design elements that goes into each of the strategies that we go live with under OpenQ. These are all the portfolios that we are live with, of which we will specifically talk about defensive momentum and pharma. But I just wanted to give you a slide in terms of all the portfolios that we have and their returns over different time frame, 1 year, 3 year, 5 year, and 10 year. So you can see that OpenQ defensive momentum over 10 years is 30%, over 5 year is 32%, over 3 years is 23%, and 1 year, last 1 year had been pretty good for 84%. So you see in all the time frame, the CAGR had been 20% plus. Pharma had been your 21%, your 15% over 5 year. This in 5 years is less than 20%, largely because last 3 years, I think 17, 18, 19, pharma as a sector was not in favor. In 3 years, pharma 23%. 26%, and now 63%. So what is interesting to note is that when you talk of sector baskets like pharma, they have a lot of tactical role to play. So we know that for last 2 years, pharma is the theme, and now after second COVID wave, people are talking of third COVID wave, probably in another 2 to 3 months, August, September. So clearly pharma is the theme to stay invested. But the good thing about sector agnostic strategies like defensive momentum and all is that every time in the market there's some pocket which is in momentum, which is displaying some strength. So defensive momentum, what it does is it automatically tilts itself towards that particular sector, and we will do some number comparison in subsequent slides. Is that if you have a particular view for a particular sector like pharma or chemicals or consumption, these are concentrated portfolios available to you, and all of them have given a pretty decent return over the cycle and has beaten their respective benchmark. If you don't have a view, but you just want to kind of invest and forget about it, look at sector agnostic portfolios like Momentum and Make in India. There are specific ones. There are, and each we can have a separate webinar on each of the baskets. So, but I just wanted to touch upon the design elements, how it is playing out beautifully in all the baskets over the cycle. One more thing on the design part of it is the number of stocks. I've been asked many times that, you know, momentum is a very high risk trending factor, and when momentum crashes, a lot of people lose money. Then why don't you have enough number of stocks to diversify, so that if momentum crashes, at least diversification will prevent them. Now, this is a slide which tells you that once the number of stocks in the portfolio is around 8, 10, 20, the reduction in risk is not that material, right? Your serious decline in risk happens only when you move from one stock portfolio to around 6, 8, 10. After that, the decline in risk is not that material. But still, if you keep on adding stocks in the portfolio for the sake of diversification, the risk remains the same, the return gets diluted. And we will see this when we compare OpenQ strategies with the respective benchmark. So within OpenQ, all the portfolios that we have will typically have constituents between 10 to 15. We don't go beyond 15. And if for some reason we have to go below 10, max to min, we go to 8 stock, not beyond that, because as the curve says, the risk increases. What is interesting to note is that this research is not something new. It is as old as like 1970s when the CAPM model and others were in prevalence, which said that if you want to make higher returns, you need to take higher risk. At the same time, this is the research which tells you that you can still make higher return by taking concentrated bets. How does the risk play out? We will look at the numbers subsequently. Now, this is the historical performance of OpenQ defensive momentum in detail. Now, as I was talking of risk, you see, we are a 10 stock portfolio, and we all know Nifty 500 is a 500 stock portfolio. The risk is very similar, but the return is double that of Nifty 500. And this is, we are talking of over the cycle, that is 20-year CAGR. If we talk of individual years, every single year, every single time frame, the concentrated portfolio has outperformed the benchmark. But then if the market crashes, then what's the drawdown? So in 2008 global financial crisis, when it was a credit crisis because capital was not available, market Nifty 500 fell by 64%, we fell by 54%. In 2020 pandemic, we again fell by less than 7% less than the market. As I said, that because of the defense mechanism and implicit profit booking, which keeps happening on every rebalancing, all these things comes together in controlling the risk, thereby maintaining the return as well. Another important feature of this strategy is look at the sector exposure. Right now, the portfolio is little heavy on the cyclicals, not little heavy, actually the entire allocation is on the cyclicals. The basic materials, you will have stocks like Grasim, which is like cement heavy stock, Ultratech, steel sectors. In financials, we have few stocks like SBI and all. So it is a representation across different sectors, but all of them are cyclical sectors. And we all know that beginning this year, Jan onwards, cyclicals have been in favor compared to the defenses, which was the flavor last year. And that is the beauty of momentum factor, that it automatically tilts itself towards the sector or the stock, which is in favor by the market right now. Similarly, take the case of Pharma. Pharma, again, has a better performance than Nifty. Pharma has a similar kind of a risk. Drawdown is less than the benchmark in global financial crisis. The difference is not very stark, but in 2020 pandemic, we fell half that of the Nifty Pharma. Now it's a sector stock. We both are in the same sector. Nifty Pharma is more diversified. We are more concentrated. Still, we have a lower we have a lower drawdown and similar risk, thereby controlling the return. And within Pharma, these are the second level categorization. So we have some exposure in diagnostics, some in in pharma, some in hospitality. When we say pharma, we are talking of pharmaceutical ingredients, APIs and all. And the beauty about this OpenQ Pharma is that we all know of companies like Laurus Lab, Granules, and others today. But last year, when these stocks were giving you bumper returns and API, that is active pharmaceutical ingredients, was not that big a story, there was still some story getting built into the pricing, that is the stock prices. And these stocks were part of our portfolio much before the stock became a favorite in the market, and the API theme became favorite last year. And because of presence of these stocks is why you can have a higher return with a concentrated portfolio without increasing your risk as well. Now, this is an interesting slide. I would want to spend 2 minutes on this slide, just talking about the numbers a bit. This slide does not only talk about the annual return numbers. That is a no-brainer, and anybody can look at the slide. What this slide tells you is that look at every time the crisis happened and market came out of the crisis. So 2008 crisis happened, 2009 market recovered, pharma gave you over 100% return. Nifty Pharma gave 61%. 2020 pandemic happened, we came out of the market, pharma gave 68, 69% return. Which basically, and this has happened every time a crash happens. When the market is coming out of the crash, the first leg is led by defensive like pharma or technology sectors. And eventually, later on is when the cyclicals come and takes that bull run to its next leg. And we are seeing this theme playing out very beautifully in the current pandemic. So if you compare 2009 return of OpenQ Pharma with defensive momentum, you will see that defensive momentum only had 66% return, whereas pharma had 112% return. Gradually, because pharma was playing out as a theme, momentum tilted itself towards pharma, and then the return started converging till 2014, when India government came in and cyclical started performing and momentum outperformed the defensive pretty handsomely. That happened in 2017. Again, in 2020, we were over tilted in pharma till September, and then we started moving towards information technology as a sector. In 21, we moved into cyclicals. You would remember that before the budget came in, market was correcting a bit, and after the budget, market started moving up. OpenQ defensive by that time have already moved into cyclicals from defensive, and it did well, whereas pharma year to date is 6% because of the recent pharma rally. And this difference basically tells you that every time a crash happens, go for defensive, which defensive momentum by definition, by design goes into it. But if you are not invested in the portfolio, if you are designing portfolio for yourself on an individual basis, that is how you should look at every time a crisis happens. One point is, one can argue that in 2003 also a crash happened, but why don't we see that theme being played out? Why is momentum outperforming the pharma? Because 2003 was not a secular crash, it was specific to IT sector. So that is why we were not overweight on IT at that time, and that is why the defensive as a theme was not as prominent as we are seeing it today. Similarly, now these are monthly returns. As I said that, from once we started coming out from March 2020, the pharma as a theme was playing out, and defensive momentum was slowly and gradually building its exposure to pharma. So you'll see by September, the pharma and defensive momentum, we had a very similar return because we are around 80% exposure in defensive momentum in September. And from October onwards, the exposure to pharma starts coming down and exposure to IT starts increasing. And I think by November, we have around 70-80% in IT and only 20% in pharma. And by Jan-Feb, we were pretty heavy on cyclicals. So you will see that while whenever a pharma has performed, defensive momentum has performed, and whenever pharma has not performed, defensive momentum has still performed, making it sector agnostic, one of the top picks from the OpenQ offerings in advisory portfolios. This is another important slide. A lot of time people show returns in terms of annual returns or returns over time frames that I show, but that does not tell you what should be your holding period. So the way we look at it is that the holding period should be the period during which your rolling returns stop giving negative numbers. So for instance, like in defensive momentum, you will see that over 1 year period, there are still few traces where the portfolio has given negative return. But over 3-year period, the portfolio has never given negative return. So if you can hold the portfolio at least for minimum 3 years, after that, the process of compounding takes over, and then the wealth creation happens on its own. Same is with pharma, though in case of pharma, even over 3 years, there had been few traces of negative return, particularly because as I said, 18, 19, 20 was not a period where pharma was in favor. So, but we did not have massive negative return. It's just that the strategy has not given you enough returns during those 3 calendar years. But typically most of the open queue portfolios, if you hold it for minimum 3 years, then at least your negative return is ensured, and then the compounding takes care of wealth creation on its own. And the beautiful part of it is that the whole thing is available to you on a click of a button, thanks to WealthDesk and PL India, further Lilladher platform, for giving us the opportunity to offer our research offerings to the end clients. With this, I think I'll stop, and Samir, do you want to make your presentation now, or should we take the questions?
So I think we can quickly go through Abhishek explaining how the investment can happen, and we can open up for questions. Please add your question there. I see a couple of them on the chat. You can also use the Q&A to add in your questions. And Abhishek, if you can.
Sure, Samir.
Yeah.
Thank you, Sujit. So good evening, everyone. So we at WealthDesk have created this platform keeping in mind the end investors. And always our core area of focus has been ease of execution. So I'll be demonstrating you how you can invest in a WealthBasket within few minutes with the help of a video. So the first step is you can go to plindia.wealthdesk.com, where you will see the list of various WealthBaskets available for you, created by Quantec Capital. So you have to log in using your PL India trading credentials. Okay, you can see various WealthBaskets available. So you click on login, and you have to log in using your trading credentials. Once you click on login, you will land up on the discovery page, where you will see various WealthBaskets. So you can select any of the WealthBasket. You can also see CAGR, risk, and minimum investment amount. And for the WealthBaskets where SIP facility is available, you could also see SIP available. So you can also create SIPs in this WealthBaskets. So once you select a WealthBasket, you could see CAGR, risk, minimum investment, benchmark, the WealthBasket is tracking, product type, published date, and also various details about the product is available. If you scroll down, you can see the fee charge, and you can download a fact sheet to get into the details about the WealthBasket. So in this fact sheet, you can get a detail about the strategy, the description about the WealthBasket, various return over a period of 3 months, 6 months, 1 year. So once you have decided that you want to go ahead with the WealthBasket, you can scroll up and click on the subscribe button. So once you click on the subscribe button, you will have to fill a risk profiler. So this is for a new investor, and this is a one-time activity. You can always update your risk profiler as and when your risk circumstances changes. So this is a one-time activity where you have to answer 13 questions, and this takes less than 2 minutes to complete the risk profiling and answer all the questions. Basis of this question will give you a risk score, and based on that, a few WealthBaskets will be suggested to you. So once you submit your answers, we'll calculate your risk profile attribute basis on the questions you have answered. And then the next step is to complete the KYC form. This is also a one-time activity, and you have to submit the KYC to the advisor, which is mandatory as per the regulatory guidelines. So filling this risk profile KYC form also takes less than 2 minutes. The next step is to validate the investment advisory agreement with the help of a OTP. The OTP is sent to your mobile as well as your email. So you will receive an OTP and you have to validate the agreement entering the OTP. And the next step is to enter the investment amount. So here the minimum investment amount is 10,000 and I'll proceed ahead with 10,000 only. So you have to click on continue. And your advisory fee will be calculated basis on your investment amount and the fee which is been charged by the advisor. So here the advisor is charging 0.5% of the investment amount semi-annually. So on the basis of my investment amount, my fee is calculated as 50 and 9 rupees GST has been charged, and the fee will be validated for 6 months. So you can pay the subscription fee via UPI or net banking. Once you pay the subscription fee, you are ready now for execution. So you will get a stock split and you can verify the stocks that the advices which are being issued by the advisor, which is present in your WealthBasket, the quantity and the value, and you can continue to place order. Once you continue to place order, you will be redirected to the terminal when you can submit your orders. Once the orders are placed, you will be redirected to my portfolio page where you can track your investments. So this is how your my portfolio page will look like, where you can track all your investments. So here you can see the consolidated performance of the portfolio, your realized P&L, your unrealized P&L, dividends you have received. And when you scroll down, you can see your WealthBasket level performance, and you can click on any of the WealthBasket. When you can track the WealthBasket performance, you can see current active holdings that are present in your WealthBasket. You can see the total portfolio value, profit and loss, realized, unrealized P&L, dividends that have been received. And you can also, if you wish to add, you can just click on buy more and you can add additional lump sum. And if you if you are willing to exit, there are two options available. Either you can completely exit the WealthBasket or you can partially withdraw your funds as per your requirement. You can also further drill down into the performance of the WealthBasket. Where you can see various performance metrics, your subscription timestamp, your portfolio IRR, and the index IRR. And you can also see your active holdings, which are currently present into your WealthBaskets, and any past transactions that you have done in the WealthBasket. You can also download the performance PDF to get the detailed insight of your WealthBasket. You can see your holdings, any transactions which you have made in the past, and dividends which is presented stock-wise. In case there is a rebalancing in your portfolio, say advisor is, advisor issued few new scripts or they have booked profits. So you can come to your pending actions and you can see if there are any pending rebalancing. And we also send you payment reminders. So in case the advisory fee is pending, you can always come to the payment reminders tab. You will see the advisory fee, if any pending, and you can pay the fee and renew your subscription for it. So if you have any questions, Samir, we are done with the investor demo. So if we have any questions, we'll be more than happy to answer it.
Yeah, Abhishek, there are a few questions in the chat window, so maybe you can go through that, how to pay for
Sure.
the fee and some of these things. So let's take those up. So one question is, can the fee be paid by credit card?
So the fee cannot be paid by credit card. You will have to pay it by net banking or UPI. So you can simply just pay the fee via Google Pay. You can just scan the QR code and you can pay the fee, or you can use the net banking option.
Right. And these are available through the PL mobile app as well?
So currently the WealthBaskets are not available through the PL mobile app.
Okay, so this URL is the only way for them, for investors to go and log in via
Correct.
PL credentials and then do it.
Yeah.
Understood. There was another question, which was who decides the application between different OpenQ portfolios? So I guess the answer to that would be one is, of course, depending your risk profile. What are the wealth baskets that are relevant to your risk profile? You can always choose to still invest in ones which are slightly different. But other than that, it's up to you. You can check out the details that are there on the wealth basket page, which Abhishek had mentioned, which has all the details about the historical performance. The PDF has other information as well, and then basis that you can take a call. Is there any lock-in period for wealth basket?
Yeah. So there is no lock-in period for your WealthBasket. You can exit and and take entry in the WealthBasket anytime.
Yeah, so it's actually very simply, these are only stocks that are being traded in your PL account. In the backend, that is what it is. The WealthDesk platform just makes it easy to invest as a portfolio. But other than that, it is as if you had invested in, if you had bought a stock or bought a share, that's how it is. It's just that with the advisory portfolios that OpenQ has, you are able to invest in specific themes and sectors, but you will actually see all these stocks in your account. There are no exit charges. There are no exit charges as far as advisory is concerned. It's like whenever you sell shares, whatever would be your appropriate brokerage, that still remains. So like I said, it is very similar to buying and selling shares, but with the added advantage of it being advisory portfolio led. So actually, Sujit, this is a question for you. Sorry, Abhishek, you have a point?
No. So I was just direct question to Sujit.
Yeah, Sujit, there's a question for you about the cyclical.
Right, at current market level, what's your suggestion on cyclical or the next boom? Well, at the time of my presentation, only I said I'm not in the business of forecasting. So I will wait for the market to tell me where is the next cyclical boom is going to come, and I will tilt my portfolio, or the process will tilt the portfolio accordingly in that direction. Because I mean, forecasting is like a 50-50 chance, right? You flip a coin, 50 times you go right, 50 times you go wrong. Why do you want to invest with an advisor who goes wrong 50% of the time? So we are a process-driven firm. We will wait for the market to give us the signal rather than we trying to forecast the market.
Right. Thanks, Sujit. Another question regarding the advisory. Yes, it is 0.5% for the OpenQ portfolios. I think across all of them, Sujit, it is 0.5% for 6 months, correct?
Yeah.
On here. Yeah. So that is the one that is the advisory fee, correct? 1 second. I know there's a question that's come up multiple times on small cases. We'll try and address it. Let me just go through the other ones. No entry exit load or no expense ratio. Yes. In very simply put, what will happen is, now you saw in minimum investment amount is 10,000. So you will go, if you are choosing 10,000, the advisory fee will be, let's say 0.5%, which is 50 rupees, with GST is 59. You pay by your UPI or through net banking, 59 rupees is paid. You will then be shown the stock split. Then you simply are at a very simple crude level, you are just investing in those stocks. And then whatever is the applicable brokerage, only that remains. There is nothing else. At the end of the subscription period, given that the subscription is taken for 6 months, at the end of 6 months, you can renew it so that you continue getting the rebalancing. Because every 1 month or so, there is a rebalancing that is sent, where you just have to click. It's a couple of clicks and your portfolio, your wealth basket gets rebalanced. That's it. It's as simple as that. So that's why it's a very it's an amazing concept, as mentioned by Mr. Virendra. Okay, Sujit, I hope you're going through the other ones. Let me just try and this question about the practical comparison between WealthBaskets and small cases. See, at a fundamental level, WealthBaskets and small cases are very similar. Both are portfolios based on themes, sectors, ideas as well. So it all comes down to the performance that particular portfolios, be it WealthBaskets or small cases, can give you, the strength of the advisors, and the like I said, the quality of advisory that is coming through. So I would highly recommend that if you're considering investing, whether it is any portfolio, whether it is WealthBasket or small cases, obviously do your due diligence, do your research, look at the performance, look at the backtested performance, and go ahead and make that decision. So at a fundamental level, like I said, WealthBasket and small case are essentially portfolios. So you have to decide whether this is a portfolio that you like, this is an advisor that you resonate with, this is a theme that you like the returns that you're getting, and then you go ahead and invest. In this case, because there is a seamless integration with Prabhudas Lilladher, you'll be able to execute it right from your broking terminal. So hopefully that helps you understand a little bit about the similarities as well as some differences as well. Sujit, I don't know, there's this very detailed question on the number of scripts of ITC. If you've gotten a chance to go through it.
Yeah, so this is more regarding how do we manage WealthBaskets on the WealthDesk side. So the question really is that if an investor already has a stock in his Demat account and the same stock has been advised by the advisor for booking profit. So when the WealthBasket is recommended to you, the entire WealthBasket journey is maintained by WealthDesk independent of your Demat account. Even though the shares will be credited in your Demat account, but the P&L, the amount of shares that you need to book profit and the actual return you have made purely on the WealthBasket, not on the shares which are part of a Demat account, apart from the WealthBasket. That entire journey and cycle is maintained by WealthDesk, and the entire information is provided to you, and it will be available to you once you log into your account through the WealthDesk credential. That will be available to you once you subscribe to it. Will the complete basket be redeemed? No, only the ones that are sent for rebalancing. So like, let's say if you have invested into 1 lakh of rupees in the portfolio, and out of that only, let's say 2 lakh worth of portfolio needs to be rebalanced. That is 2 lakh needs to be sold, 2 lakh needs to be bought. Then only 2 lakh plus 2 lakh, 4 lakh worth of transaction will happen in your account, not 10 lakh plus 10 lakh, 20 lakhs. So the transaction happens only on the delta value, not the entire portfolio value. Hope that answers that question. Next is, it is all according to technical analysis. Not really, because as I said that factor investing is essentially a 3-step process. What to invest is whether a stock is a quality stock available at a good price, and whether stock is displaying some momentum or not. In a technical analysis, typically what you do is you look at indicators like moving average crossover, ADX, RSI, money flow index, and whatnot. So while technical analysis also works well, people who are skilled in technical analysis have been able to make decent amount of money. We are not in the business of technical analysis. We are pure quant-driven firm that uses some sort of a mathematical and statistical evaluation to come up with an algo-driven portfolio. So, okay, after that, I think, Samir, that's for you. Rebalancing will not happen automatically. I will get an email notification for it. Achha, Abhishek has already replied.
Right. Correct.
Yeah. Any other questions? Is there any human intervention in taking decision on buying and selling? No, there is absolutely no intervention. So a lot of time, even though I have created the algos, a lot of time I myself will not be knowing which stocks has gone in and which stock is getting sold out. It's completely quant driven.
Yeah, and Sujit, right now rebalancing for, let's say, these two WealthBaskets, Pharma and Defensive Momentum is on a monthly basis?
Yes.
Okay, so which means that from the date, so let's say if you've invested today, 21st May, the next rebalancing SMS or email you will get will be on 21st of June.
Yes, and one important
Roughly.
point I want to highlight is that 1 month will depend from the date of investment of each individual investor. So what will happen is if somebody invests today, so his 1 month will be over on 21st of June. If somebody invests tomorrow, his 1 month will be over on 22nd of June. And I'll tell you why we have designed this process and how does that help. Normally what happens is when you design a portfolio based on certain signals or based on information that market has given you, you design a portfolio today after the market has closed by assimilating all the information, and then you start trading that portfolio tomorrow. So which means that there should be maximum of 1 day lag between when you are constructing the portfolio and when you are trading the portfolio. If I start having one rebalancing for all the customers who are coming at different point in time, there will be a lot of customers who will be getting a portfolio which was created, let's say 10 days or 15 days before. So it is almost like a portfolio which is getting expiry date. I'm giving that portfolio to the customer, which both from compliance point of view as well as from advisory point of view is completely wrong. So that is why at the WealthDesk level, we have worked very closely to make sure that the customer level rebalancing cycle has been designed. And that is what we maintain on all the OpenQ portfolios.
Understood. Thanks, Sujit. Also, I think one question I had, Sujit, for you was, let's say if defensive momentum minimum amount is 10,000, right? But let's say I put in 1 lakh. So my stock split compared to, let's say, Abhishek, who puts in 10,000, would that also be different?
Yes, and good question that you raised that, Samir. So now let me explain that with the help of an example. Now, what defensive momentum essentially does is it picks up the stock which is showing strength in the market. Right now, let's say we find stocks like Page Industries or MRF. MRF is an 80,000 stock. Now, typically these are 10 stock portfolio which will have 10% allocation. If I put MRF in that, the minimum investment amount of my portfolio becomes 8 lakhs of rupees. Nothing wrong with it. If somebody wants to invest 8 lakhs of rupees, we have an unconstrained version we can put in there. But if somebody has an investment constraint that I want to invest only 1 lakh or 2 lakh, there are enough stocks in the market which are also showing enough momentum and has the potential of generating good returns. So what we do is, of those 10 stocks, we exclude MRF, which brings down the minimum investment amount from 8 lakhs to whatever the amount it is. And we replace that with the next best momentum stock, which could be, let's say, 1,000 rupees stock or 400 rupees stock. So what is happening is we are maintaining the same logic. We are maintaining the similar kind of risk return profile over the cycle, but we are able to match the minimum investment amount requirement of the end customer. So there, to answer your question, the name of the stocks could be different, but there would be a lot of overlap. The lot of stocks name will be still very similar between 10,000 stock portfolio and a 1 lakh stock portfolio.
Right. Okay, I think we've largely covered most of the questions. I think that needs to be. There was one question: do we need to have an account with PL for investment through WealthBasket? We, of course, have other partners as well. This particular webinar is being conducted with Prabhudas Lilladher, and if you have a Prabhudas Lilladher account, you can directly log in with your credentials that you use for trading, and you can directly invest. So that's the benefit of having an existing trading account with Prabhudas Lilladher. Just got sidetracked with a couple of questions coming in. Again, I think Sujit, maybe a couple. Yeah, you already answered that. Okay.
Yeah,
cool.
for Piyush. So
Yes.
there's one from Vasu. So rebalancing decisions are taken daily, only communicated once a month, depending upon the investment day. Yeah. So because we have a customer level rebalancing in the backend, we do generate portfolio every day, but the daily portfolio might not be relevant for all the investors on a daily basis. So what is relevant for you, Vasu, you will be communicated only that portfolio on your date of rebalancing, and other customers will be informed depending upon their completion of 1 month cycle. And to do that, we have to maintain a process that captures portfolio on a daily basis. That's right.
Okay.
So, Amir, there was one question which I think we should address. So the question is, do we have to pay something every time for the rebalancing? So the answer is no. Okay. Once you have paid the advisory fee, the time period till your advisory fee is valid, you will be getting rebalancing notifications free of cost. So there is no additional charges you have to pay for the rebalancing.
Correct. I'm just typing this out because somebody had asked this question. So, as to what is the total fee. So I'm going to be putting it in the chat as well, but just to make it super simple, I will just reiterate. Let's say you have a wealth basket that you're investing for 10,000 rupees. The advisory is 0.5% every 6 months. When you are making the 10,000 rupee investment, your advisory fee will be calculated as rupees 50, which is 0.5%, and rupees 9, which is the GST. So rupees 59 for a 10,000 rupee investment is the only advisory fee that you need to pay. Once you have paid the advisory fee, you see the stock split, you go ahead and invest in those stocks. Those stocks will reside in your account. And then, like we discussed, there are monthly rebalancing. There is no advisory cost for the rebalancing. There is no exit fee for when you exit. You can exit partially, fully, anytime. The renewal happens every 6 months in this case. So it is recommended that obviously you continue paying, so you keep getting rebalancing and you continue getting the benefit of the advisory. And other than that, there is nothing else. It's as simple as that. The brokerage is the standard brokerage that you would have with your broker, Lilladher. There is nothing different that is there, right? Okay, I think we are towards the end of this webinar. I think it's been a very interactive one. A lot of very interesting questions coming up. Yeah, go ahead, please.
I think there's one question in the Q&A tab. I don't know if you want to take that.
Which one are you referring to? I think we've talked about most of them.
If any of my clients subscribe in your services, what sharing can I get?
Oh, I think that's more of probably a franchisee or some other kind of a model. So I'd recommend that you reach out to somebody, either if you're affiliated with Lilladher.
Sandeep here. I'll just clarify that. So the advisor keeps the advisory fees. The broker keeps the brokerage, right? So whatever is the normal brokerage is what gets applied to the customer's account. And whatever is the normal sharing for brokerage is what goes to the franchise.
Understood. Yeah. Thanks, Sandeep. So, all right. I think that's it for this webinar. So, Sandeep, did you get a chance to attend most of it?
I did actually join towards the end, but I'd like to thank all of you for organizing this. Sujit for personally being here, Samir, Abhishek, Aman, to the participants for joining in and making it such an exciting and long webinar. I mean, it's very nice to see so many questions, which shows to the amount of value that people see in these portfolios. So I would encourage all of the participants to actually look at these portfolios very closely over the weekend. Assess what suits their risk profile, assess what suits customers' risk profiles. The minimum size is fairly small and the fee is, virtually negligible for the quality of advisory that you get and the kind of talent that is behind creating these portfolios. So thank you again, everyone, for doing this for us at WealthDesk and Sujit, personally, like I said. Thank you.
Thank you so much.
Thank you. Thank you.
Thanks.
See you.